if something's going to break, we want it to break soon. So you see the volatility flaring up.
Looking at periods of volatility like we've just had recently, where the VIX has spiked up considerably, and how people generally panic, and we see some downturns. I mean, we saw a 3.74% sell-off recently, which seemed epic in its in its size, but really if you put it in context, it's not. So let's look at this graph here.
Yeah, it seems to feel worse than it is recently in terms of the volatility, right?
Yeah.
And so we're trying to get at that phenomenon. And what we have here, each of these series of bars are different episodes of the VIX spiking. VIX is the volatility index, the fear gauge. It measures, basically what it does is you go out to the options market for the S&P 500 and you pull back option prices and you say, how much volatility is the market expecting? When the VIX is going up, it means options investors are expecting a lot of volatility going forward. It's the fear gauge. So in each of these instances, the VIX went above 30, and you can see, and this goes back to 2000, how much the S&P 500 went down from peak to trough, and what the return was for the S&P over the next 30 days in green. And historically, if you were to get a VIX spike over 30, typically you would see the S&P 500 fall at least 10%. Right. At least 10%. Recently here, so in 2021, we had 2 VIX spikes above 30, and the S&P was down 4%. Absolutely nothing. So it feels way worse than it is.
Yeah.
Which is very interesting. You talk about a lot of reasons why this dynamic might be happening. The fact that interest rates are so low, the TINA effect is so large, the fact that there's a lot more retail trading in the options market, so maybe option prices aren't as effective or aren't as useful as a fear gauge as they used to, perhaps because there are less sophisticated investors there that might pay way too much for a put. It might not be rational. So a lot going on there, but
Well, and the wealth effect is more meaningful these days than it was 20 years ago.
Yeah.
And you've got a lot more people who are either retired or living off their income, and they would have problems if there were significant drops in their wealth, correct?
Yeah, definitely. Everybody's far more sensitive to asset prices going down, and nobody really wants it.
Yeah.
So yeah, a lot of that going on, and the other thing you see is, if especially last 20 years, if you want a good buying opportunity, this goes back to everybody wants a buying opportunity, but nobody likes it when it actually comes around, right? So you wait for the VIX to spike, get above 30, wait for it to spike and start coming back down, and then buy.
Yeah.
And
or as it's at 30, or
yeah,
on its way up to 30 there. Yeah.
And what you see in green is you typically get a very positive return over the next 30 days.
Yeah.
That's that's what a buying opportunity looks like, right? I mean, being down 4% though, that's not even much of a buying opportunity. No. There are areas within the market that were certainly down more. This is an index, so it under the hood, there's a lot more volatility in terms of individual stocks, but it's not even really a buyable dip. It's more like you just practice your hold discipline, not your buy or your sell discipline, and you just stay committed to being overweight equities.
So when does this type of signal tell you it's not a buying opportunity?
Yeah. Well, apparently you would have to see well over 80 on the VIX, and you'd have to see a number of highs on the VIX. So just continuing, we've talked about VIX failures. So it tries to get to 30, it gets there, and it comes right back down. Right. And then it spikes up to 30 again, and it comes right back down. If you get a shot above 80 and you're running above 40 for an extended period of time, it seems like another shoe is dropping and the S&P is continuing to fall. It's a buying opportunity, but maybe not yet. You think last time we had that was March 2020.
Right.
I mean, the VIX was going absolutely nuts. The market was struggling to find a bottom, but it came, and it was a good buying opportunity.
Sure, yeah, for sure. What else does volatility tell us day to day, month to month, about what we should be thinking forward?
So the other way that this is useful is looking at the term structure of VIX futures contracts. And so this is something I think was probably most effective to look at last year around election time. So basically what happened was there was a lot of fears heading into the election that there was going to be something unprecedented we had never seen before. And a lot of folks sort of got scared out of their equity positions. And what you saw if you looked at the VIX futures market, so not just looking at short-term expectations of volatility, but how much could you buy volatility for going out 30, 90 days, right. You saw a clustering of people buying volatility around the election. And the way to use that, the first order would say, okay, evidence that people are afraid something's going to happen around the election. The second order of thinking you could apply to that is, everybody is clearly already positioned for something bad to happen. If everybody already has one foot out the door, then when something bad does happen, there isn't going to be sort of a rush for the door, right? Everybody's already positioned for something bad to happen, so they don't need to scramble and reconfigure their portfolio when it actually does happen. Right. So that's probably the most effective way to look at this, is to measure the level of complacency. When VIX futures are high, investors are not complacent. They've put downside protection in place. And so that thing that you're worrying about that could actually really hurt markets, it may happen, but the market reaction might not be that big.
Yeah. Often what we see is the exact opposite.
And then the opposite is true as well when you look out to the VIX futures curve and it's running at 10 and you see people double short the VIX, 2x leverage short VIX, and it's, wow. You could have something like Volmageddon in early 2018 where you just get a couple stocks going the wrong way in the S&P 500 and, a hot payrolls wage growth number. And then all of a sudden, areas of the VIX market and the equity market just blow up overnight. Yeah. That's far scarier.
Yeah, it's definitely been a buying opportunity, at least as far back as we can remember, whenever the VIX spikes up there. So we've used it to our advantage. It's awesome from our research team to put those together. Thank you very much. And if you have questions, let us know.